If you're relatively new to stock trading, or even if you've been doing it for a while, you'll know that it's pretty challenging. It's difficult to beat the market consistently. Some people do it, most people don't. So in this video, I'm going to share with you 5 things that I wish someone had taught me when I started trading 35 years ago. Let's jump right into the list. Number 1, profitable trades come from a breakdown in market efficiency. Breakdowns occur when there is abnormal trading activity. Now, this always makes more sense when we look at a chart. And so what we're talking about here is abnormal price moves and abnormal volume. Most stocks, most of the time, aren't worth trading because most stocks, most of the time, just trade in their normal price patterns, normal volatility. They don't make the big moves. As traders, we want the stocks that make the abnormal price gains over a relatively short period of time. So if we're day trading, we want that stock that can move up 100% in an hour. If we're swing trading, we want that stock that can make those big moves over the course of 1 or 2 weeks. Position trading, those big moves over a few months. All of these trading styles have common characteristics. They all start their big abnormal price moves with abnormal activity. So let's dive back into the chart here and I'll show you what I mean. So you can see here that this stock was pretty boring into the close on Friday. This is actually an aftermarket trade, which is not something normally I would focus on, but this stock made such a big jump after hours on Friday that I thought I would show this one. Now you'll see here that I have these little pink and yellow dots on my chart. That's my own indicator. I call it an action candle. I call it an action candle because it shows that there's trading action, that something has caused traders to want to chase this stock higher. Now usually, it's because the company issues a news release that's got some big exciting announcement. Sometimes it can be a rumor. Sometimes it can be promotion in social media. All of these things can be combined to cause a stock to make the big moves. So what I look for are these big abnormal moves out of low volatility. Now, why is that important? Because if we believe in the efficiency of the market, what we're really saying is we believe that all available information is priced into the stock and investors are rational. Well, that's actually not always the case. There are times when new information is being priced into the stock. And when a stock starts to trade abnormally from total low volatility, it's usually because there's some new information coming into the market and that will cause the stock to go up to reflect that new information. So if a biotech company announces that they have a new treatment for cancer and it's been successful in trials, that's going to make the stock go up very quickly. Now, the second component of this is when stocks trade abnormally, investors get emotional. They have the fear of missing out, and it causes them to chase the stock higher, which makes the stock go up even farther than it should. So if, a stock is trading at $5 and the news is worth maybe $5 a share extra, so the stock should trade at $10, okay, it's going to go from 5 to 10 pretty quickly, but it will typically overshoot the $10 because of greed, because of the fear of missing out, and might cause the stock to go all the way up to $15. And so if we go back to our example here, you can see that this stock started at just under $7 and in the course of 3 minutes moved up to $10, had a little pullback, and then rallied all the way up to $20. That's the kind of stock we want to trade. It makes big gains in a short amount of time. You don't need a lot of capital to take advantage of that sort of big move because you're going to get big profits with a relatively small position. So abnormal activity indicates that there is a breakdown in market efficiency, and that's a sign that we can make a profitable trade. All right, next one on the list. Big losses will destroy you. You have to plan to lose. This is so important. You're not going to be right all of the time in the market. We'd love to be right all the time, but we will never be right all of the time. In fact, if you can be right 65, 70% of the time, you are an excellent trader, which means that you're also going to lose 3 to 4 times out of 10. The key then is to not take a big loss. You will be wrong sometimes, and you need to plan to lose. So the question then is, how do you do that? Well, some beginners will say, well, I will never take more than a 10% loss. Don't do that. It makes no sense. Because one stock having a volatility to the downside of 10% is very different than another stock. In other words, Microsoft moving down 10% is a huge move for Microsoft. But a 10% downward move for the stock that we're showing in my examples here is nothing. It could happen in the blink of an eye. So what you have to do instead is go to the chart and look for floors. When I buy a stock, I'm always thinking, where is the floor? And I use this concept of inflection points. You'll see here this other little indicator that I have on these charts, these little plus signs. That's one of the ways I find support. Sometimes I just look for little areas of floors. So if there's a little floor there, a little floor there. That's where the market has established a floor, which tells me that if price goes back down through that floor, I should sell. So when this stock first started to behave abnormally here, the floor was there. So if I'm going to buy right here, that's where I plan to lose. If I buy the break of this pullback right here, then my floor is there, and that's where I plan to lose. So I'm always planning to lose at the last floor. I usually go a little bit below that. What that does then is it allows me a point, a floor price, where I can establish my risk. If I'm buying at $10 and I know that the floor is $9, then my risk per share is $1. And if I don't want to lose more than $100, I'm going to buy 100 shares. All right, so always plan to lose. Let that guide what your position size will be. All right, next one on the list. We are not trading stocks, we are trading situations. Say that to yourself because it may not make a lot of sense. I'll show you in just a moment. Trades must have a positive expected value. So let's jump back into the chart. We are trading situations, and situations occur when the upside is considerably more than the downside and the probability of success is high enough. So this is called the expected value of a trade. If I have a situation on the chart, and I'm going to show you this in just a moment, where I think that I've got a 70% chance of making $2 per share and a 30% chance of losing $1 a share, then I have a trade that has a positive expected value. If I did that 10 times, 7 out of 10 times I would make $2, so that's $14 in profit per share. And 3 out of 10 times I would lose $1, so I'd have $3 in losses after 10 trades. $14 in profits, $3 in losses per share. That's $11 per share in profit. So that is a trade with a positive expected value. Now, just to carry this a little farther, you could have a trade that has a 90% chance of being successful, hypothetically. I don't believe that that's the case, but let's just say, hypothetically, you have a strategy that says you are right 90% of the time. All right, sounds like a great strategy. However, we don't have enough information yet to determine if that's actually a good strategy because we don't know how much we make when we're right versus how much we lose when we are wrong. Imagine 90% of the time you make $1 a share and 10% of the time you lose $30 a share. Is that still good? 9 out of 10 times you make $1, so you make $9. 1 out of 10 times you lose 30, so you lose 30. So you actually lose overall. So this comes down again to understanding the situation. So let's go back into the chart and I'll show you how this plays out. If I buy the stock here, my floor price is there, that's my risk. And I would say that this at that point has a 70% chance of going higher. I know this because I've traded a long time and I know that that particular setup is going to work 7 out of 10 times. On the other hand, let's say I buy this breakout. Okay, I'm breaking through resistance, I've got optimism, I've got a lot of good things, but in this scenario, this is my entry point, this is my support point, this is my risk. See how the risk is a lot bigger here than it is here. I also know that because the stock has been going up a long time, my success rate is probably only 50% that it's going to go higher, maybe even 30% that it's going to go high enough to compensate me for my risk. So it's the same stock, but it's a different scenario, a different situation. I'll show you one other little example here. I could buy this stock here with support there, or I could buy it on this little breakout right there with support here. What do you think is better? Well, it's actually this entry that's better because my risk down to support is much smaller than my distance down to support here. So these are some of the things that I teach in the courses I do, and if you want to learn more about that, go to stockscores.com. I'm just trying to give you the broad overview in this video, and there's a lot more detail. We'll have some free classes coming up in October, which you can sign up for on my website. I'll show you how to do that later in the video. They're free for 4 hours of classes. All right, so that's the situation, not trading the stock. Next one, winners have to pay for losers. Let the winners win. Again, this comes down to expected value. Sometimes you're going to be right, sometimes you're going to be wrong. When you're wrong, we're going to have small losses. When we're right, we have to let the winners win. So if we go back to the chart, if we buy, my favorite entry rate is right here because I love to buy breaks of pullbacks. So the stock goes up abnormally, it pulls back and it breaks the pullback. My entry is here, my support is there. So I've got a nice risk relationship with reward. My reward from there is, who knows how high it's going to go, but because it's early in the trend, it's quite significant. Now then, if as the stock is going higher, I'm going to stick with the trade as long as the upward trend is intact. So if I draw a line here like this, that's my trend line, and my exit point is right there. Now, if you are an emotional trader, you may buy here, and you might sell here because there's a little bit of weakness. Or you might sell here because there's a red candle, or here because there's a red candle. But the proper place to sell is there, meaning that you've earned on this trade a risk reward of, this is the risk right here, you've earned 1, 2, 3, 4, roughly 4 times your risk. So you had a trade that had a 70% chance of working and a 30% chance of losing. If it lost, it would have lost you 1 risk reward element, and if it wins, in this case, it made +4. If you can do that 100 times in a year or 100 times in a month or whatever, you're going to make a lot of money. Because then the only thing that separates you from making big money in the market is just adding more risk. So if you want to be successful, make sure not only you plan to lose and limit the size of your losses, but you also let the winners win. When you're right, let that trade pay you. All right, last one. Patience for quality. Wait for the valid trades. This is a very difficult thing for beginner traders to do because they want to make money. They want to work hard. They want to get in and make some trades. And in doing so, they take trades that maybe have a lower quality, a lower chance for success. And the problem with that is that by not taking the optimal trades, they're taking trades because they're bored, they're taking trades because they're desperate, they're taking trades probably because they have the fear of missing out. All of those things combined are going to lower your success rate, are going to lower your average profit, or perhaps even increase your average loss per trade. And then you're going to go into a death spiral of emotion. What's going to happen is you're going to start to worry and make bad trades and get anxious, and you're stop thinking, your amygdala, that part of your brain, the fight or flight brain that caused you to panic, that's going to take over. You're not going to make good decisions, and you're going to death spiral into more and more losses, bigger and bigger losses. And that is really why most beginner traders lose. They get emotional, they get panicked, and they make bad decisions. Trust me, I've been through this. I've done this for 35 years. I have taught thousands of people how to trade the stock market, and it's the most common problem is the emotion. You've got to keep emotion out of it. One of the ways to do that is to be fussy, to be patient for the trades that meet the requirements of your strategy, a strategy that should have been proven to be an excellent strategy, where it has a positive expected value, where it works consistently over time. All right, last thing I want to show you, just jump into my website here, stockscores.com. If you want to receive my free weekly email newsletter, you can sign up for that right here. I do this every weekend, or every Monday actually. You just, right here, click on this, and you can register for that. I told you earlier in the video that I'm doing a 4-part educational series, more in-depth analysis of these theories. I'll get into some strategies. I'll show you the tools that I've developed that I've shared with, thousands of people over the years. I've been teaching for 30 years, and you can learn a lot just by attending some of those free classes. I hope you've enjoyed this video. If so, please do me a favor, click on that like button. I'd like to hear from you. What do you find to be your greatest challenge in trading? If you can share that with us, then I'll maybe use some of those things for a future video. If you've not already subscribed to the channel, please do so as well. And as always, trade well.